Cool. All right, so we're looking at Greek exposure with less than 7 days till expiration, DTE. So those short-term YOLO trades is kind of what we're looking at today. And we're looking at it from the short premium side, of course. If you trade primarily long premium, you can just kind of flip everything that you're looking at, and it'll give you an idea of the exposure and the changes in your Greeks based on, changes in the factors that we're going to look at here. So, of course, a recap of just, what Greeks affect the others the most. So when you're looking at delta, of course, delta and vega are our highest priority. Vega and theta become less of a priority with shorter duration options because you're more dependent on the price of the underlying. You're going to be much closer to the current price of whatever you're trading. So it relies heavily on the price of that underlying at expiration and that time passage through expiration. So here, when you're looking at delta, the changes in delta are going to mostly come from vega and gamma. When you're looking at vega, your changes in vega are going to come from delta and theta, or are going to have an effect on delta and theta. With theta, of course, it's our lowest value or lowest important Greek for our trading because we just know that we're on the short premium side. We always have positive decay. We're not really heavily focused on the exact number, but theta is going to be affected by vega. And then gamma, of course, it depends on expiration. With this look, it's going to be the most important thing, or one of the most important things that we're looking at here. And of course, it will affect your delta exposure.
Indeed. Here we go.
So here
it is.
Same structure as we looked at yesterday. The way we bucketed these is looking at three factors, right? So you have the passage of time. In the gray bucket, you have the orange bucket. That's volatility changes, so increases or decreases. And then the next bucket being price movement in the underlying, either towards your strike or away from your strike, so that this is applicable to both calls or puts if you're using those, if you're doing one-sided trades. So here with the passage of time, the biggest thing you're going to see is a decrease in your delta and a decrease in your gamma. And this is for options that are, somewhere at 30 deltas or less. So you're talking about further out on the distribution. Those options, and this goes with what we talked about on the last slide, you have exposure to vega and theta, but it's not the biggest part of the exposure. It's going to be the delta exposure. Your 30 delta option 7 days out in time is going to be much closer to the at the money strike versus something that's 40 or 50 days out in time. And so that's the biggest part of the exposure is your delta and therefore your gamma. So as time passes, your delta is going to change significantly. And if all else equal, if the stock doesn't move, if volatility doesn't change, you're going to see that delta rapidly come down, whereas the further out options are going to stay relatively the same. So you might, from a 7-day option, you might go from a 30 delta, the next day down to a 25, the next day down to 20. You might lose 5 deltas a day based on the passage of time, where a 30 or 40 day option, you might only lose 1 delta or sub 1 delta on a day-to-day basis. So keep in mind your delta exposure is going to move very, very quickly with the passage of time, and it's going to decrease all else equal. And that's going to be the same with gamma. Of course, as your options get to lesser and lesser deltas, they're going to have lesser and lesser delta change based on movement in the stock, which is your gamma. For volatility changes, of course, with increases in volatility, you're going to see an increase in delta. Just imagine the umbrella, as Mikey has used, moving up on the distribution. So if you have a 30 delta option, your option might go to 40 delta or 45 delta. Again, if you're further out in time, those options might go from 30 delta to 31 or 32 delta. So you're not seeing as big of an increase. The increase is much bigger with these shorter dated options. Of course, that's going to, if you have an increase in volatility, you're going to see vega and theta increase because you're going to have more vol exposure, more extrinsic value, which means that you're going to also have more theta decay. The one thing to keep in mind is that your gamma exposure will probably stay flat, maybe decrease a little bit, just because the expectation of price movement becomes much wider. So the options uncertainty or certainty of being in the money or out of the money becomes much wider, which means that your gamma exposure is actually going to decrease when you see volatility increase. And that's the exact opposite. When you see volatility decrease, you're going to see everything come down, and your gamma exposure is actually going to increase depending on where you are on the distribution. For your stock moves, so when you're looking at moves towards your strike, everything's going to increase. Everything's going to increase fairly rapidly. If you're getting moves away from your strike, you're going to see everything decrease and decrease very rapidly. That's the biggest thing here is these Greeks are much more elevated versus what we were looking at yesterday with our standard 30 to 50 day time frames. These move a lot quicker.
Yeah, and when it comes to gamma exposure, what you need to think about, I think, is just extrinsic value. Is there a lot of extrinsic value to offset intrinsic value in the option as it moves in the money or out of the money? And that's why if you look at an options chain with 1 day to go or 2 days to go, like for this Friday, let's say, if you have an options chain that has 100% IV, the gamma is going to be very low relative to your SPY that has 20% IV, 25% IV, where gamma is going to be much higher because there's just not as much extrinsic value to offset intrinsic value moves. So thinking about gamma changes in terms of extrinsic value, I think makes it easier if this is a little confusing.
Yeah, it's a good point. We'll jump over to the next one here. So we're looking at the money now. So you can see things are changing as you get closer to at the money, and they're really going to change when you get to in the money as the position becomes more synthetically a stock position. So with at the money options, and these are really the options that we're most worried about keeping until expiration because they change very quickly. The passage of time is going to have less of an effect on your delta and your vega, but you're going to see increases in gamma exposure as well as theta to some extent. So think about it this way. With at the money options, whether you're looking at 7 days or 70 days or 700 days, at the money options are always going to be right around 50 deltas. So your option doesn't really, the delta exposure doesn't depend on time directly with at the money options because they are 50 deltas. What happens is that the change in the stock price, the movement in the stock price is going to rapidly change that delta versus the further out in time, or is going to rapidly change that delta versus further out in time options, where you go from a 50 delta to a 100 delta very, very quickly. And that's gamma risk, and what we talk about with options and why we roll positions further out in time is to avoid that change from 50 to 100 deltas with minimal movement in the stock price. So as time passes, the biggest things that'll change will be your gamma exposure, which is the rate of change of delta, and your theta will increase as well because we know that those at the money options are going to hold value up until expiration. That's why straddles decay slower than strangles on a percentage basis. So for vol changes, like increases and decreases, you're going to see minimal change in your delta exposure across the board. It doesn't matter if volatility increases or decreases. Again, at the money options always have 50 delta or right around 50 delta. So the volatility isn't really changing your delta exposure, it's really changing your gamma exposure, which can change your future delta exposure if that isn't confusing enough for you. So with increases in volatility, of course, you're going to have more vol exposure, more theta decay because the extrinsic value is likely to increase, but your delta and gamma are going to stay the same, but they're going to stay high. When you see a decrease in volatility, this will actually increase the gamma risk you have on the position because, again, when you think about the distribution of expectations and that umbrella risk profile, when you tighten that in, it becomes more likely that that option is in or out of the money, meaning that the probability of it being in the money becomes greater than if it's high volatility where there's tons of projected price action. So your gamma risk actually increases as you get closer to expiration and as volatility contracts. For movements in the stock price, of course, you're going to see an increase in delta as the stock moves towards your strike. So if you have short puts, the further in the money it goes, the more delta you're going to pick up. Your gamma risk, though, doesn't really change because the rate of change is so high. So you go from a 50 delta to a 70 delta, your delta increases much greater than what the rate of change of your gamma is going to be. You go straight from 50 to near 100 when you're in this sort of time frame. And once you get to near 100 deltas, you know that your position becomes more like a stock position, and you don't have vega exposure, you don't have theta exposure. It's all intrinsic value. All that extrinsic value goes away.
Yeah, when extrinsic value goes away, gamma increases, which is why you see this when vol decreases, gamma increases. As time passes, gamma increases. That I think is the biggest takeaway here for at the money options. It's that the fact that you have a lot of gamma exposure as extrinsic value goes away, which is just another reason why we like to roll these positions out in time, avoid this kind of binary nature of these options, and put ourselves in a more conservative situation, if you will.
Mm-hmm. So the next slide here, once these options get in the money, so this will look at in the money, short dated options. Of course, as time passes, your delta is going to increase. So if your option goes from a 50 to a 70 delta, as the next 5 or 7 days passes, that option is going to go from 70 up to 100. So you're going to see an increase in delta exposure. Of course, everything else is going to decrease, and this is just the decay of extrinsic value. Your option becomes more of a stock position. It becomes intrinsic value versus having an out of the money option that's all extrinsic value. So it's all about intrinsic and extrinsic value. Of course, the changes in volatility don't have much of an effect on your option position because there's very little extrinsic value. So you become less affected by those Greeks and more affected by delta and gamma exposure, which decrease if you get a vol increase because those options become less likely to be in the money. When vol decreases, they get more likely to be in the money, which means that your delta exposure is going to increase. You're going to get closer to 100 deltas. When you get stock moves towards your strike or away from your strike, so this is why we talk about at a certain point, it makes sense to take static delta versus having a dynamic delta like a deep in the money short put, is that once you get a movement towards your strike, so your option's in the money and the stock, let's say you have an in the money put and the stock increases and goes towards your strike, you actually lose delta. So instead of having 100 deltas into that move, you might have 100 deltas and then, the next dollar you have 90 deltas and the next dollar you have 80 deltas. So you actually lose deltas in the direction that you want the stock to go. And that's kind of counterintuitive to what you want for that position. So keep in mind that in the money options, when you do get that move towards your strike, you're going to see a decrease in your delta exposure, which means each consecutive dollar actually makes you back less than the previous dollar, and that's further offset by the changes in volatility exposure that you have because you're going to increase volatility exposure with at the money options. You're pumping in extrinsic value. That extrinsic value is decreasing what you're making back in delta on those moves.
Yep, and this is again why if we have a deep in the money short option that has very little vega exposure, very little theta, it's because there's not much extrinsic value and we're not really benefiting from rolling a deep in the money option forward if we're only collecting 10 cents to do so. Mm-hmm. We would rather just take the shares, and that way if you do get the reversal you're looking for, you get that delta back 1 for 1. You don't have to be in the situation where your delta is decreasing, extrinsic value is being infused back into the option, which isn't necessarily good for you because you didn't sell that extrinsic value to begin with. You just have to now wait for you to get that full value.